we will complete our discussion about standard costing and variance analysis. By the end of this session, hopefully you will be able to explain what is standard costing and discuss its role as a cost planning and a control tool. You should also be able to set a standard cost and conduct a variance analysis. In addition, you will be introduced to the standard cost accounting system that uses standard costs in making entries and recognize variances in the accounts. The first question that we need to answer is, what is a standard cost? Standard cost is an estimated cost per product unit predetermined by the company. So it is estimated and predetermined in advance and ahead of actual point of time of incurring costs. Standard cost is estimated based on analyzing historical manufacturing cost data, industry norms, and technical estimates. So many factors contribute to estimating standard cost. Analyzing historical cost data from previous years, analyzing industry best practices. For instance, relying on what is standard labor time required to produce a similar product according to the industry best practices is an example of how analyzing industry norms contribute to setting standard cost. Technical estimations from technicians and engineers also contribute in setting standard cost. For instance, industrial engineers contribute to setting standard costs by giving information about labor time requirements, and quality control engineers also contribute to setting standard costs by giving information about standard price of raw material and so on. Standard costs are used as a target cost by the company for comparing it with actual cost, and the difference will be the variance. So standard cost is the target cost that should be achieved by the company, and it should be compared with actual cost that happen at the end of the day, and the variance or the difference between target standard cost and actual cost should be analyzed. In the previous chapter, we have explained what the master budget is, how it is prepared, and its role in cost planning and control. So an important question that we need to answer right now is, what is the difference between standard and budgeted costs? Both standard and the budgeted costs are indeed predetermined expected costs that contribute to cost planning and control. However, there is a difference in the way the two terms are expressed. Standard cost refers to specific cost per product unit, and the budgeted cost refers to total cost given a certain level of activity or production volume. So the difference is clear right now. Standard cost is a cost per unit, however, budgeted cost is total cost. Budgeted data are not journalized in the cost accounting system. In contrast, standard cost may be incorporated in the cost accounting system. And as I mentioned previously, in this session, we will be introduced to the standard cost accounting system, how it uses standard cost in making entries, and how variances are formally recognized in such a system. Standard costs are estimated based on analyzing historical manufacturing cost data, industry averages. Also, input from technicians and engineers are useful in estimating standard costs. However, budgeted costs are also affected by management sales plans. Budgeted costs are estimated based on analyzing historical manufacturing cost data, industry best practices, technical estimates, and budgeted sales volume and the production volume influence the budgeted cost amounts. Standard costing and the related variance analysis play a very important role in controlling costs, in controlling manufacturing costs of material, labor, and overheads. The standard costs are mostly taken from the industry best practices. That's why analyzing the variance, the difference between actual and the standard costs, directs the management attention to the difference from the planned amounts. So when management become aware that actual manufacturing costs have differed from the standard planned or expected cost, they need to take, if the variance is unfavorable, they need and significant, they need to take corrective actions to avoid such unfavorable variance in the future. If actual costs are greater than standard cost, the variance is unfavorable. Unfavorable variance has negative implications. It indicates that the company has paid too much for one of the manufacturing cost elements or used the element inefficiently. So it alters the company that actual profits will be less than expected. That's why management need to analyze the underlying reasons of unfavorable variances and take corrective actions to avoid such unfavorable variances in case of significant unfavorable variances, to avoid such variances in the future. On the other hand, if actual costs are less than standard, the variance is favorable. Favorable variance has positive implications. It indicates efficiency in incurring manufacturing costs and in using material, labor, and overheads. In case of having favorable variance, actual profit will likely exceed planned profit if other variables are remain constant. What are the steps of standard costing? The first step is to set standard cost for different manufacturing cost elements. The second step is to record the actual costs. The third step is to compare standard with actual and to determine the variance. The difference between standard cost and actual cost is the variance. Step number 4 is to analyze the variance to know its underlying causes. Finally, analysis of variance is reported to top management to take appropriate actions wherever needed. The setting of standard costs require input from all personnel who have responsibility for costs or quantities. In specific, cost accountants provide important input for standard cost setting process. They accumulate historical cost data and analyze how costs behave and respond to change in the level of activity or production volume. They can decompose cost into fixed and variable components. Fixed cost remains constant regardless of the level of activity. However, variable cost change in proportion to the change in the level of activity or production volume. Many other parties contribute to setting standard costs. For instance, to determine standard cost of raw material, cost accountants consult purchasing agents, production managers, and quality control engineers. And to set standard cost of direct labor, cost accountants obtain pay rate data from the payroll department and obtain information about labor time requirements from the industrial engineers. A product standard cost is the sum of standard cost of raw material, standard cost of direct labor, and the standard cost of overheads. Standard cost of raw material can be obtained by multiplying standard quantity of raw material required to produce a single product unit by the standard price per direct material unit. In setting the standard quantity of raw material required to produce a product unit, a single product unit, we need to consider or allow for waste and spoilage, in addition to the material required to produce a single product unit. And in setting standard price per direct material unit, we need to consider purchasing price, freight costs, and receiving and handling costs. Standard cost of direct labor can be obtained by applying or by multiplying standard hours required to produce a single product unit by the standard rate per hour. And in setting standard hours required for production, we need to consider actual production time, rest periods, and setup and downtime periods. In setting standard labor rate, per hour. We need to adjust for cost of living, changes in the cost of living, payroll taxes, and fringe benefits. Standard manufacturing overhead cost can be obtained by multiplying predetermined overhead rate by the standard direct labor hours. And this is in case of using direct labor hours as the indirect cost allocation base. Machine hours can also be used as the indirect cost allocation base, and if so, machine hours should be used. Standard machine hours should be used. Predetermined overhead rate, as mentioned previously in the previous chapter, can be obtained by dividing budgeted manufacturing overhead cost by budgeted direct labor hours. To set standard cost per product unit for cross-manufacturing company, we need to multiply standard quantity by standard price for each manufacturing cost elements. 4 pounds of raw material are needed to produce each product unit, and the standard price per pound is $3. That's why the standard cost of raw material is $12. 2 hours of direct labor are needed to produce each product unit, and the standard rate per hour is $15. That's why the standard cost of direct labor is $30. 2 hours of direct labor are needed to produce each product unit, and the predetermined overhead rate is $5 per direct labor hours. That's why the standard cost of overheads is $10. By adding $12 standard cost of raw material, $30 standard cost of direct labor, and $10 standard cost of overhead, we can obtain standard cost per product unit, which is $52. So far, we have learned how to set standard cost of a given product. Now it is the time to learn how variance between actual and the standard cost should be analyzed. Let's carry on with our example about cross-manufacturing company. Cross-manufacturing company incurred $55,000 to produce 1,000 product units during the first quarter of 2019. The following direct material and direct labor data pertain to the operations during the first quarter. 4,200 pounds of direct material used to produce the 1,000 product units, and the price per pound paid is $3.1. 4,000 pounds should have been used to produce such a production volume given the standards, and the standard price per pound that should have been paid is $3. 2,100 hours are used to produce the 1,000 product unit, and the rate per hour actually paid is $14.8. However, 2,000 hours should have been used to produce the 1,000 product units, not 2,100 hours, and this is according to standards, and the standard rate per hour is $15. We are required to conduct variance analysis. Total variance can be obtained by subtracting standard cost from actual cost. Actual cost incurred to produce the 1,000 product unit is $55,000. It is mentioned in the given information that $55,000 are incurred to produce the 1,000 product units. We need to subtract standard cost from this amount to obtain the total variance. Standard cost is $52,000. How can we obtain this figure? We can obtain this figure by multiplying standard cost per product unit, $52, by the production volume, which is 1,000 units. So the standard cost in total is $52,000. So actual cost exceeds standard cost by $3,000. There is a variance, and the variance is unfavorable. $3,000 unfavorable variance. Such variance can be analyzed into material variance, labor variance, and overhead variance. Let's start with analyzing material variance. Material variance can be obtained by subtracting standard cost from actual cost. Actual cost can be obtained by multiplying actual quantity by actual price, and the standard cost can be obtained by multiplying standard quantity by standard price. And the information related to direct material are given over here: actual quantity, actual price, standard quantity, and standard price. So actual cost seems to be higher than standard cost. That's why material variance is unfavorable. $1,020 unfavorable material variance. Such variance can be analyzed into price and quantity variances. Price variance can be obtained by applying actual quantity to the difference between actual and the standard price. Actual price is higher than standard price. That's why material price variance is unfavorable. $420 unfavorable price variance. Quantity variance can be obtained by applying standard price to the difference between actual and the standard quantities. Actual quantity of raw material used to produce the 1000 product units is 4,200 pounds, and the standard quantity that should have been used to produce such a production volume is 4,000 pounds. So the actual quantity of raw material is higher than the standard quantity that should have been used by 200 pounds. That's why the quantity variance is unfavorable, $600 unfavorable quantity variance. So the $1,020 unfavorable material variance consists of two components: $420 unfavorable price variance and $600 unfavorable quantity variance. Unfavorable material price variances can be attributed to market price fluctuations, differences in the specifications of purchased raw materials, and normally the purchasing department is responsible for material price variances. Unfavorable material quantity variance can be attributed to the inefficient use of raw material, the waste and spoilage, and inaccurate product specifications. And normally the production department is responsible for variances in the quantity of raw materials. Labor variance can be obtained by subtracting standard cost from actual cost, and actual cost can be obtained by multiplying actual hours by actual rate, and standard cost can be obtained by multiplying standard hours by standard rate. And the information related to labor hours and rates are given over here: actual hours, actual rate, standard hours, and the standard rate. So actual cost seems to be higher than the standard cost. That's why labor variance is unfavorable. $1,080 unfavorable labor variance. This can be analyzed into price or rate variance and quantity or efficiency variance. Price variance can be obtained by applying actual hours to the difference between actual rate and the standard rate. Actual rate is lower than the standard rate, which is good. That's why labor price variance is favorable. $420 favorable price variance. Quantity variance or efficiency variance can be obtained by applying standard rate to the difference between actual hours and standard hours. Actual hours that is used to produce the 1000 product units is 2100 hours, and the standard hours that should have been used to produce such a production volume is 2000 hours according to standards. That's why actual hours is higher than the standard hours that should have been used. So the quantity or efficiency variance is unfavorable. $1,500 unfavorable efficiency variance. So the $1,080 unfavorable labor variance can be analyzed into $420 favorable rate variance and $1,500 unfavorable efficiency variance. As mentioned previously, we need to understand the underlying reasons of unfavorable variances. Unfavorable labor rate variance can be attributed to workers' misallocation or paying workers different wages than planned. And normally, the production department or HR department is responsible for labor rate variances. With respect to the labor efficiency variances, unfavorable labor efficiency variances can be attributed to workers' inefficiency caused by poor training or lack of supervision, or even faulty machinery can cause unfavorable labor efficiency variances. The production department is responsible for such unfavorable efficiency variances. So far, we have analyzed material variance and labor variance. Now we are going to analyze overhead variance. Overhead variance can be obtained by subtracting applied overhead from actual overhead. It's mentioned in the given information that the company incurred $6,500 variable overhead and $4,400 fixed overhead to produce the 1,000 product units. The predetermined overhead rate is $5 per hour and the standard hours allowed for work done is 2,000 hours. You need to recognize how the predetermined overhead rate can be computed by dividing budgeted overhead cost by budgeted direct labor hours. And standard hours allowed for work done, standard hours that should have been used to produce the 1,000 product units is 2,000 direct labor hours. This can be simply obtained by multiplying two standard hours of direct labor required to produce a single product unit by the 1,000 units production volume. So actual overhead can be obtained by adding fixed overhead to variable overhead. $6,500 fixed overhead and $4,400 variable overhead. So we have $10,900 actual overhead. Overhead applied or allocated can be determined by multiplying predetermined overhead rate by standard hours allowed for work done. Predetermined overhead rate is $5 and the standard hours allowed for work done is $2,000. So by multiplying the $5 predetermined overhead rate by 2,000 hours allowed for work done, we can obtain overhead applied or allocated, which is $10,000. So actual overhead is higher than the standard overhead by $900. So the overhead variance is unfavorable. $900 unfavorable overhead variance. So we have analyzed the difference between actual and the standard cost and found that cross manufacturing company has $3,000 total unfavorable variance. Such a variance is analyzed into material variance, $1,020 unfavorable material variance, labor variance, $1,080 unfavorable labor variance, and overhead variance, $900 unfavorable overhead variance. What are the causes of overhead variances? Overhead variances can be caused by having business expansion carried out during the period that wasn't planned for at the time of setting standard cost, or having an increase in one or more of overhead expenses during the period, such as unexpected increase in insurance premium or unexpected increase in the price of electricity that is used to run machines, and so on. Now we will explain the standard cost accounting system. It is a double entry accounting system that uses standard costs in making entries and formally recognizes variances in the accounts. Companies may use it with either job order costing or process costing. In the previous semester, we have explained the job order costing system. That's why we will combine it with the job order costing system. What is the advantage of using standard cost accounting system? When accountants use standard cost system to record the transactions, companies are able to quickly identify variances. In addition, inventory, uh, raw materials inventory, work in process inventory, and finished goods inventory, and the related cost of goods sold are stated at standard cost, which simplifies the bookkeeping process. The first entry that should be made is to record the purchase of direct material and related price variance. To record the purchase of direct material, we debit raw material inventory by the standard price of the actual amount used and credit accounts payable by the actual price of the actual amount used to produce the 1000 product unit. And the difference between the account payable balance and raw material inventory balance is the variance. And if the variance is unfavorable, it should be debited. In this case, we have unfavorable material price variance. That's why we debit material price variance account. If the variance is favorable, it should be credited. In specific, to determine the amount of raw material inventory, we should multiply actual quantity by standard price, and remember from the given information about cross manufacturing company, 4,200 pounds are actually used to produce the 1000 product unit, and the standard price per pound is $3. To determine the amount of accounts payable that should be credited, we multiply actual quantity by actual price. So we multiply 4,200 pounds that are actually used to produce the 1000 product unit by 3.1 actual price per pound. The difference between actual cost and the standard cost is the variance. Actual cost is higher than the standard cost in this case. That's why the material price variance is unfavorable. $420 unfavorable material price variance, which is debited in this case. The second entry is to record the use of raw material in production and the related material quantity variance. And this transaction is recorded when raw material is issued for production and sent to the manufacturing floor. To record the use of raw material, we debit increase work in process inventory and credit decrease raw material inventory, because raw material is transformed into work in process inventory. That's why raw material should be reduced and work in process inventory should be increased. To determine the amount of work in process inventory, we multiply standard quantity by standard price. And to determine the amount of raw material inventory, we multiply actual quantity by standard price. And the difference between the two figures is the variance. We have $600 unfavorable material quantity variance. And this is consistent with our variance analysis calculations. So material quantity variance is debited by $600. Now we need to record direct labor transactions. Remember from our previous calculations, we calculated two variances for direct labor at cross manufacturing company, rate variance and efficiency variance. How are these variances recorded for transactions related to direct labor? Because labor is not inventoried for later use like materials, only one journal entry is needed to record direct labor transactions that include these variances, both efficiency and rate variances. In a specific, work in process inventory is increased debited and wages payable account is increased credited, and favorable labor rate variance is credited, and unfavorable labor efficiency variance is debited. In specific, to determine work in process inventory amount, we multiply standard hours by standard rate, and according to the given information, 2000 hours should have been worked to produce the 1000 product unit according to standards, and the standard rate per hour is $15. And to determine the wages payable amount, which should reflect the actual cost, we multiply actual hours by actual rate. 2100 hours are actually used to produce the 1000 product unit, and the actual rate per hour paid to workers is $14.8. According to our previous calculations, labor rate variance is favorable, $420 favorable labor rate variance, which is credited, and efficiency variance is unfavorable, $1,500 unfavorable efficiency variance, which is debited. Now we need to record overhead transactions. Remember from the last semester we have explained how job order costing system is used to track production costs. In a specific, manufacturing overhead account is debited, increased when overhead cost is incurred, when actual overhead cost is incurred, and decreased when overhead is applied to products. At the end of the accounting period, the balance in the manufacturing overhead account represents the over-applied or under-applied overhead and is closed out to cost of goods sold. So we need to debit manufacturing overhead account for overhead costs incurred. The credit goes to several different accounts depending on the nature of the cost. If the cost is related to indirect material, the credit goes to accounts payable. If the cost is related to indirect labor, the credit goes to wages payable. If the cost is related to depreciation expense, the credit goes to accumulated depreciation, and so on. So far we have recorded overhead cost, actual overhead cost incurred. Now we need to record overhead applied to products. To record overhead applied to products, we debit increased work in process inventory by the amount of overhead applied, and credit manufacturing overhead account, decrease the account by the actual overhead amount. And overhead variance is recognized in this stage. Overhead variance is unfavorable, that's why it is debited. Overhead variance is not recorded at the time overhead cost is incurred. It is rather recorded when overhead is applied to work in process inventory using standard hours allowed for work done. The last entry is related to the transfer of work in process into finished goods. We make an entry related to this transaction by debiting finished goods inventory and crediting work in process inventory. And to determine the amount, you need to review all the debits to work in process inventory throughout this chapter. You will see costs related to raw material, direct labor, and overheads, all recorded at standard cost. Finished goods are sold for $70,000 on account sale. Uh, so we need to record the sale of finished goods and recognize cost of goods sold. To record the sale of finished goods on account, we increase accounts receivable and debit accounts receivable and increase credit sales revenue. We need also to increase cost of goods sold, which is recorded at standard cost, and decrease finished goods inventory. is the cost accounts with variances. All debit balances in variance accounts indicate unfavorable variances, and all credit balances indicate favorable variances. This is the income statement prepared for management under the standard cost accounting system. Cost of goods sold is stated at standard cost, as mentioned previously. By subtracting cost of goods sold from sales revenue, we can obtain standard gross profit. Variances are disclosed separately, and total variance is unfavorable, $3,000 unfavorable variance. That's why it should be deducted from standard gross profit to obtain actual gross profit. So actual gross profit is lower than the standard gross profit by $3,000. And finally, selling and administrative expense should be deducted to obtain the bottom line figure of earnings. That's it for today, and I would like to thank you so much for listening.